Welcome to members, and I know we have a number of guests here tonight, so welcome to you as well. This forms part of the 3 events in the year which we dedicate to looking at economic outlook. This time of the year tends to be the one we invite Roman Scott to come back, backed by popular demand, as it were. So it's great to see him. Again, for this event, let's recognise support from the Fry Group, who have been sponsoring this and many of our meetings throughout the year. The Fry Group was established in 1898 with a tradition of tax planning and financial management. It's headquartered in the UK, of course, with a global presence, offices here in Brussels and in Hong Kong. On a personal level, it's great to welcome Roman back for 3 reasons, really. One, he used to be very proactive in the Chamber as a board member, and of course as our economic spokesman. Secondly, professionally with the Insight Bureau where I work, we work together. Great to see you back. And thirdly, he's simply an excellent presenter, and I think we're in for a treat. Roman splits his time between Singapore and Sri Lanka these days. There are various entrepreneurial exploits that he's taken on there, including the Uluwatuna Beach resort and the F&B franchise for coffee bean and tea leaf in Sri Lanka and Bangladesh. He's also the chairman of the Kalamanda Group, which is a Singapore-based investment holding company with interests in real estate, hotels, consumer and agribusiness. This also incorporates Kalamanda Capital, which looks after its fund management unit. So Roman has been around in Singapore for many years. I think he arrived in 1998 with Gemini Consulting. I remember you arriving actually. But spent most of his time in Singapore with the Boston Consulting Group, where he focused on financial services sector, involved in restructuring WMs in Southeast Asia, and developed the risk credit management unit and the wealth management and private banking division. So with that, I know we're in for a good treat. Let us hand over to Roman Scott and see what we have in store for 2014.
Thank you very much. Is this on? Can you hear me? It's always lovely to be back. What I'm going to do is try and treat you, as I do every year, to about an hour's worth of heavy economics with investment at the end. I'll make sure it doesn't go beyond that. The good news for this year, I know many of you should be very happy and smiling, and you've all made a lot of money. I think in the last couple of years, and very strongly last year when I stood in a different building about the same time, I urge you all to buy the S&P and go into US equities and do nothing else, which is what we did for our investment portfolio. So you should be up by about 20-23% by now. Given we made the same prognosis for the year before, I'm hoping that you've all made at least a third. You should have stayed out of bonds, so you won't have taken any losses on your debt portfolio. But if you recall, a lot of what I talked about in the last couple of briefings, we had to spend a lot of time on politics rather than economics, which always makes me a little bit uncomfortable. And the nice thing this year is we'll be going back to economics, which will drive the market. So for those of you who are investment advisors for IFAs, it's back to thinking very carefully about how world economics and particularly sort of monetary factors are going to work out. So you're going to need to do your homework for your clients, and then we'll get onto the investment part at the end. What I do now, since the last few years, we have gone from just being an economics-focused, here's the year ahead, or the half year ahead as we used to do it, to also incorporating investment advice and being sponsored by IFAs. I try and spend a bit of time on investment and tell you a little bit about what we're doing at Kalamanda, where we're investing, where to place your bets for the year. Before I start, I just press the down button, do I? I'll use this. I've already had a couple of comments that I expected on, what's with the dodgy moustache. And of course, Bridget, lovely to see her as ever with her charming German directness, saying, you're looking older and you're looking fatter. She didn't say you're looking wiser, and you've got a dodgy moustache. So I actually quite like the moustache, but it's more for this thing called Movember, which I'm a very, very firm believer in. So all the men in the room should be sporting moustaches for the month of November. Now, as you know, there's been a lot of attention on female breast cancer. There's been a lot less attention on the male equivalent, which is prostate and testicular cancer. I hear that one of the reasons why more men are dying from that than women are from breast cancer is it's easier for women to sort of work out whether they got it by feeling them than it is for men to feel whatever they're meant to feel. But it is a very, very important thing. I strongly believe in it. Sadly, I know someone who actually got prostate cancer and didn't live because it was too late, and so hence sporting moustache. There are some very, very good people out there who you can donate to in the cause of research. This is always a bit of experiment. When you're a mixed kid, you know, how's the moustache going to come out with? And the reason why it looks, you know, fairly bedraggled and pathetic is, you know, would it be my father on the left? By the way, he does actually look like that. Or would I get the moustache that my mother would bequeath me? My mother doesn't have a moustache, by the way. But she is Sri Lankan, and the Sri Lankan male equivalent, as sported by President Rajapaksa, is that. So I tried it, and I ended up with this pathetic thing here. I'm not quite sure how they get these bits coming out the end, but that's the mix for you. I'm going to keep it, I might keep it afterwards, so those of you who don't approve, tough. I'm going to, as I said, go through the usual stuff. We have a formula that seems to work. Quickly cover geopolitical risks and politics. Luckily, we'll be able to spend less time on that this year, thank God. Republicans and Tea parties notwithstanding. Then we can quickly get on to the global macro story. The good news here is, as from now, things are going to look a lot better. Next year should be hugely better for economics, and 2015 even better. Right? So we're looking at escape velocity, which is good for you, good for investment, but a more difficult investment environment, and I'll tell you why. I'll talk a bit about money, because money, in my book, will remain the most important thing to focus on. And if you are IFIs and investment advisors, and you don't want to spend too much time on economics, you will have to continue to look at monetary policy and the central banks, because they will still be the driver. And then I'll talk about emerging markets. I put that in because we always focus at the end of the year on looking forward, what are the big issues? What's my take on the big issues to clear the fog? Many of you, like me, are very long emerging markets, in my case, frontier markets. You most probably got bruised during the summer meltdown in emerging markets. What's going on? Is it going to carry on? Should you be careful with your investments in the emerging markets, where in the long run, I'm still very bullish. And then we'll look onto the investment side at the end and look at how we did. Before we start, let me just answer why is it called On the Wings of a Dove? Actually, several doves, because most of the central bankers, thank God, are now in the dovish camp. And why I will be continually taking my dove anti-hawkish view. Now, I usually around this time, just before I speak to you, and always after, get various emails from various punters, investors, people who know me, even my own investors, so investors who actually invest with Calamander or Calamander funds, which is very sweet. So I got one from David the other day, taking the hawkish position, right, and reminding me, as all good classical orthodoxy hawks should, you know, don't forget we've got a huge amount of government debt, and this quantitative easing can't go on forever, and 85 billion a month, you know, adds up to $1 trillion a year. When's it all going to end? When it ends, it will end badly. They won't be able to tighten fast enough. When they do, it will shoot up. Currency collapse. The dollar will go down. Treasuries will be horrible. You know, the whole story, right? We all know the nightmare scenario of classical orthodoxy, and of course the school of thought of the Bundesbank and the Germans. And I have to keep reminding everybody, look, I have always been a dove. I come from the wet East Coast, non-Chicago school, whatever insults the Chicago Freedmen lot throw on us. I did last year put up the Krugman Manifesto, which I signed, and I told you about that last year. I firmly believe, as all good Keynesian, you know, flood the world with easy money, provide as much fiscal support as possible. I firmly believe that current policy remains on the right path, and that is what you have to focus on. So I will be explaining to you today why I still believe in being the ultimate dove. I've been a dove in this audience for at least 5 or 6 years. And don't forget, I was one of the first to stand up here and warn everybody, along with many other naysaying economists at the time, about the build-up of American debt and what would happen to the dollar. Got me into trouble with AmCham, if you remember. But I do want to focus on why the dove policy is still good and why you have to focus on the monetary policy that the central banks are taking as part of your investment decisions and not go against it. It may be that there is a risk, and maybe that one day it will all come, end badly, but that's not yet. Now, just in case those of you think, now I'm 50 by the way this year, that I'm going to go soft and I'm going to be serious and I'm just going to focus on dry economics and I won't do all the fun stuff and insult various nation states and various central bankers. No, I'm afraid I'm still going to be just as bad as ever. It's a shame that the AmCham has since boycotted me after calling the dollar toilet paper all those years ago. Those of you who remember that. By the way, shortly before the dollar then proceeded to decline by 15% and then 25% the following 2 years. But other than that, I'm just going to warn you that we'll even have a little bit of nudity, with luck, if we can get the video to work in this time, just to make it really racy. And actually, as we've all learned, I don't miss AmCham because they listen to this anyway. I'm not quite sure which of these is the NSA microphone. Where the hidden cameras are, it's most probably this computer. But they've been listening all along. So, AmCham, can you hear us? Is Laura still there? So we will have a bit of fun along the way. I've discovered the meme from my daughter, so just to further take the piss out of the NSA thing, I thought that was quite good. I thought this one was even better, for those of you that haven't seen it. I'm not going to comment. Nothing to do with me, by the way. This one was also quite good. So, what we're going to do then is, I'm going to try and dish politics fairly quickly so we can get on to economics. But let me start with the political side. Now, if you recall, I spent a lot of time last year focusing on my thesis that it was, as I rudely pronounce, the end of economics, and that you might as well get rid of your IFAs, and get a political analyst. And most of investment risk and market movement had actually become political risk and politically orchestrated movements. And if you remember, I showed that with 3 markets, okay, which had totally different economics. So that was the FTSE Euro 300, a demand collapse, deleveraging, fiscal austerity presided over by the Germans, easy money, try credit market. You remember Euro. Completely different to the Americans, who were going down the Dove, Keynesian, demand strength, leveraging up, fiscal growth, quantitative easing, ultra support from Fed, do whatever it takes. Different economics. And Singapore, where you actually had demand strength, right? You had further leveraging, not leveraging down, easy credit, not tight credit as you had in the US and in Euroland. And they all moved, as you can see, in lockstep. Okay, it was nothing to do with economics last year. The way you invested completely followed the political, ebb and flow of the Eurozone crisis and what was going on with, are we going to bail out Greece? Are we not going to bail out Greece? Is the Eurozone going to survive? Is it not going to survive? That's what the up and down is, and the whole stability of the whole Eurozone unit and the Euro itself. And, of course, all the shenanigans going on with the Republicans, refusing to extend the debt ceiling and all the stuff they've repeated recently. It was a politically driven market. And my prognosis was, it's been a nightmare year to try and interpret investment, but don't worry, things are turning. We got rid of Trichet, thank God. We had Mario Draghi coming in. The Eurozone, I argued, would stay together, that Merkel would see sense. Yes, she's playing to a domestic political audience, but she would come through to make sure Greece was bailed out, the Eurozone would stay together, the Euro would be intact, and things would get back to normal with a lot more easy money and some kind of quantitative easing on the quiet behind Bundesbank's back with Draghi coming in. That is exactly what has happened. Okay, there is still some noise. You will still hear a little bit of noise, but this is the slide I put up last year saying you can invest now, but don't invest in Europe, invest in the US, okay, because it will be okay and the whole pig crisis will go away. There is still political bickering. At the last ECB round, the two German members, backed up by the Austrians and the Dutch, voted against the rate decline. You know, they locked off 0.25%, the ECB. So Draghi managed to push it through, but there is still German austerity resistance. As a result, what you're seeing is the return of economics, which is fabulous if you're an IFA. It's a lot easier to interpret for your clients economics than it is to interpret political noise. And you can see that the markets are moving according to their economics, which is why the US has done so well. The green shoots of recovery that finally come through in Europe, because markets react in anticipation of the good story before growth has really taken off, means Europe has done very, very well. You've all made a lot of money this year, or you should have done if you're in the right place. And notice Singapore hasn't done very well at all, right? Because the demand strength going on in the G2 economies recovery, G3 with Japan, has not yet fed into Singapore. And I'll talk a little bit about that in a minute. Why is Singapore, that I've always argued, is a leverage call option on global growth, particularly tied to Europe, the US, and Japan, the big three? Why is it not going? So we'll come back to that mystery in a minute. So on politics, rather than have extended discussions and give lots of data, I'm simply just going to give some awards as a way of summarizing what's happened that's good, what's happened that's bad, and where we're going from here, so we can remove political risk noise off the table. So my Oscars for 2013 for people who did the right thing, and I believe that history will look back on this man here, Mr. Super Mario as we call him, as one of the great saviors of the great financial recession, given the prevailing orthodoxy of hawks, austerity, and a fiscal squeeze coming out of Germany. For him to come through and change ECB policy and put quantitative easing and ram it through despite the resistance of the Bundesbank is fantastic. Long may he last, and that is the reason why the euro crisis is off the table. Right? The second, and it may surprise you to see Merkel up there, given she was one of my three witches 2 or 3 years ago. Right? She's up here for being a deft political master and winning the election, massaging all that coalition difficult politics and the conservatives in Germany and managing to come through. She now has the commanding heights. We've predicted that she would do that. She controls things, and she is a balanced person. She still leans towards the austerity, hawkish type thing, but she has worked out, she's smart enough to work out, that supporting the peripheral countries, even the Greeks, and the euro is in Germany's interest, whatever it costs the German taxpayer, but she still has to manage the domestic political voice. So she does deserve support for that, which is one of the reasons why, between those two, I believe the euro crisis is now off the table. And of course, Ben Bernanke has carried on being a wonderful dove, flooding us with free, cheap money, lots of QE. Thank you very much. That's one of the reasons why the markets have gone up so strongly, and one of the reasons why it leaks into the emerging markets, and the emerging markets did well. So those are the guys that got it right, which is the reason why we don't have to worry about politics anymore. My Turkey Awards, right, and the winner has to be, even though a European narrowly won it, and that's Hollande, who France's performance has been absolutely appalling. Their refusal to do any reform at all in their economy and get past all of the structural deficits they have, which, by the way, include one of the highest tax rates in the world at present, scaring everybody away, one of the most inflexible labour markets in the world, the shortest working week in the world, one of the largest government bureaucracies in the world. Need I go on, right? Not quite sure why they, well, actually we do know why they elected him, because the last guy, of course, was an idiot. But I have to say my biggest disappointment of all is somebody who is not an idiot, who I've actually met in my old bank restructuring days when he was finance minister, because I won't meet him now and he's on top. India is my biggest disappointment. You all know I'm a consumption economist. You all know I'm a huge believer in the emerging middle class and urbanization effect going on in growing Asia. And the entire Calamander Group solely invests in and places all its bets on that story outside of our real estate arm. India should be well ahead of where it is now, and this man, who is a very, very, very bright guy, has done absolutely nothing. In fact, he was on the shortlist for 2 awards. We have another award, which is the No Kahuna Award. Right, for those of you who don't know, Miss Hart didn't know what kahuna was, so I had to, she went and Google searched it, and I'm going to put up, for those of you who don't know what a kahuna is, what a kahuna is, but he unfortunately came through winning the Golden Turkey Award. Indian growth rates have been appalling. The rupee is at huge risk. Like many frontier investors, I have large exposure and dependency on what India does through Sri Lanka. Sri Lanka flies in the tailwind of the Indian machine. That is disappointing. And Holland, of course, and France get the runner-up. Okay. France is disappointing. It's continuing to be part of the problem in EU recovery, not part of the solution. Italy and Spain are actually doing better. Spain, which was really in the toilet, has been more reform-minded, removed more structural deficits, done more with its banks, done more with resolving a very, very, very deep housing crisis than anything that France has managed to do. So I would be more keen to invest in a Spanish bank right now, fully recapitalized by the state, than a French bank. The final word on politics will, of course, have to be the Muppet Award. We always refer to Muppets in these speeches every year, which is the great Goldman Sachs term for, dumb customers that you shove useless product on. For those of you who are investment bankers, I'm sure you use this regularly. It makes equal sense in the world of politics. I don't want to spend any time on the absurd theatre that we will be subjected to every year by the Tea Party wing of the Republicans, shanghaiing the mainstream majority, far more sensible Republican caucus and gob into doing absurd things like threatening the world's largest economy that holds the fiat currency, the US dollar, with default. Right? We don't need to go there, we know how that works. The problem is, these three continue to be there, and I don't think they're going to go away, and it does mean you are going to have volatility in markets and in your assets continuously every time this happens. My take on this, and for those of you who are advising your clients and IFAs, private investors, is ride it through, shut your ears, go away, have a nice holiday in Sri Lanka, come back, and they'll take it right up to the edge and it won't go anywhere. If you look at the markets, they didn't go down much. Liquidity was withdrawn. People just stopped trading. Transactions went. Right? So I would not get too distracted by that noise, but those three are still there. Lee is the worst, of course, because he's the young pup who's sort of following the bruiser Ted Cruz and trying to prove his mettle by being a sort of cowboy. Those of you who know Rand Paul, he fancies himself as a sort of intellectual voice of the Tea Party movement. And then, of course, we have the two fabulous nobodies down at the bottom who just go along for the ride. So, unfortunately, this isn't going to go away. We are going to have another sort of look at raising the debt ceiling. And, of course, we've got the budget debate still to happen in February. That means for those of you thinking that tapering is going to happen in the first quarter and you should adjust your portfolios accordingly, it's not going to. And easy money certainly isn't going to go away, because this will continue to take a few basis points, a few tens of basis points, to as much as 50 basis points off US growth. It most probably took about 0.5% off US growth this year, which is shameful, but that's American politics. So that's politics done with. So my core message for you is, your IFAs, you're going to have an easier job. Investors, you're going to have an easier job. You won't have to sort of worry about the political tea leaves and have political analysts running around. You will continue to get noise. 2014, 2015 will be a year of strong, positive economics, a resumption of growth in the global economy, certainly in the developed markets. It won't be strong growth, and I'll talk about why in a minute. And as a result, it should make your investment decisions a little bit clearer, at least pinned in economics, not politics. So let's go into the economics and global macro. Right, as you know, every year I use the IMF statistics, which I always say are flawed, but always the most well-researched and the most backed by good economic data. I like them. This is the main systems in the world. The world is blue line, and then yellow line is Euro, white is Japan, the sort of burgundy colour is Britain, and the US is blue. Okay? Now, that looks not too bad, right? The first thing that comes out of it is the world is ending up at 2.9 for the year. 3% and above, if you remember, my target for the world was around 3%. 3% is escape velocity when the world is growing okay. 4% is good. By this time in the crisis, if we've done the right thing, we should be at 3.5%, getting to 4%. And we will over the next 2 years. So growth has resumed, but it's not particularly strong. Okay? That figure for the US, don't forget, would be a lot better if they hadn't the government shutdown, but it's still not above the critical 2%, but it's not bad. Okay? Britain is particularly good compared to where I said it would be and how much I was anti the austerity drive of the Cameron government. Britain has done a lot better than it should, mainly because it was in such deep funk for the last 2 years. It's now starting to come out, and you're getting pent-up demand as the engines get turned on again. But the European number looks terrible, which is a blow to your hawk austerity economics, right? The doves are winning and the hawks are losing. And this is not a good pattern. This is not where we should all be right now. We should be at least 50 basis points above that. But growth has resumed. China has, as we said it would, managed a lovely soft landing, and by the way, has been the best managed economic system through the crisis. I have to hand it to those guys, even though it's not consumption driven the way I wanted, even though they haven't rebalanced the economy, even though it's still a huge amount of investment and capital spend driven, and not all of that is efficient, we know that, and even though it leads to potential housing bubbles and banking bubbles and all the stuff that the critics put on, let's hand it to these guys, judge them on the numbers. What counts is, have they succeeded? They have. Was there a hard landing? No. Look at India. What a dreadful picture. All of the opportunity they had with a war of almost free money, and they haven't managed one structural reform to really get their motor going. And as a result, their infrastructure and logistics and labour market problems and everything else that India has, and just generally doing anything in India, means it's dragged them back down to a growth rate that is at least a full 1 to 1.5% below where they should be to start moving. A very quick reminder of, this looks a bit complicated, but the bars are what I said we would do last year. The red line is what we actually did, and the blue bar is the IMF prediction last year. Remember, I haven't done the continual sort of changing of my forecasts and so on through the year, because I only see you once a year now. But as you can see, I was fortunately dead on for the world. 2.9% growth versus, I said, 3% as my base case. Europe disappointed. I argued for a 0.5% base rate. I hope the fiscal drag would be less, but we continue to have the drag affecting Eurozone. I was pretty accurate on the US. Notice that I was consistent. The reason I beat the US and I was far more accurate in my growth forecast was I was consistently more conservative, because I consistently factored in weaker demand recovery and a bigger fiscal drag effect, largely because I've lived through this before in the Asian financial crisis. As I keep telling you guys, it's going to be longer, slower, more difficult, more jobless, particularly with the fiscal drag effect, than normal recoveries. And the IMF tends to predict on cyclical recovery. The disappointment was our representative of ASEAN, which has been taken down a bit in its growth on the effect of the tapering and the potential effect of the tapering, and of course India, as we've discussed. Right, so system-wide, and for those of you who are investing in specific systems, I'll give you a quick, I won't do Japan this time. If you want to talk about Abenomics and stuff, I can answer that in questions at the end. I traditionally, as you know, don't cover the rest of BRICS that is not Asia, because I'm not interested in them. But again, I can answer questions on that. Africa is interesting, but again, we'll leave that to questions. So we focus on G3. Eurozone, right? And the hawk austerity school that Hollande foolishly followed. Let's see the scorecard. So for those of you who still believe in your hawkish positions that this is all going to end badly and we're going to have inflation, currencies are going to be debased and we have to start paying the debt down now, etc., etc., look at the result of the huge fiscal drag that the orthodox austerity school leaves you with. If the private sector is down and is not spending, and look at investment spend levels, right? We are in Europe running at less than 1% of investment from businesses and from private individuals, right? You can't grow with that. If you then, with no demand from the business sector and very little demand from consumers in retail sales, if you take the government off the table as well, oh, we shouldn't be spending anything, we should constrain fiscal spend and we should pay down debt, okay, how are you going to grow? You don't. The hawk argument is by generating the confidence of showing to be a good citizen in paying your debts down and having a better sovereign position and better ratings, you constrain inflation, you create confidence, businesses will invest and the market will do it for you, the invisible hand, but it's not doing it, right? And consumers are not spending. And so, as a result, the rap sheet looks terrible. GDP is negative in every system. And even Germany, notice I put Germany in the red even though it's slightly positive, because a 0.3% growth rate for Germany is the equivalent of almost recession, right? And you've got current account balances that are negative other than Spain and Italy who've come out. Spain and Italy have done a good job coming out, but that's not because they're exporting more, it's because their consumers are now too poor to afford expensive German imports, so they're importing less, not exporting more. So the current account deficit looks bad. And remember we said, if Germany goes and shuts down its peripheral economies and enforces austerity on them, they will buy less German goods and Germany will hurt. And that is exactly what is happening. Okay? Now, that looks bad and it is bad, but the good news is there are now green shoots of recovery, and we do have Mario Draghi, the dove, in the ECB, and he is standing up to the German Bundesbank guys, and he is maintaining easy money, and he is taking rates down because we only have monetary policy to balance the fiscal drag. Fiscal drag is an economist's word for basically government not spending money and building roads and rails and bridges and you know, propping the economy up with a little bit of demand to replace public sector, private sector demand. Right? So with that, there is the start of slow growth, which is why the stock market is doing, because stock markets always race ahead and anticipate recovery well before it's as firm as it should be. I myself still think that the green shoots of European recovery, which are there, are still a little bit weak for me to be comfortable investing in anything other than banks, which I'll get into later. But for those of you who want to invest, or those of you who did invest this year, it's not been a bad place to invest. Proof that the Germans do have a sense of humour. Again, I love this. So this is the German view of the world, the austerity orthodox, that they are suckling, you know, all of the pigs, which I love. But, you know, let us not forget, those pigs that you Germans are suckling, right, you depend on them. 60% of German exports go to fellow Eurozone countries, which is why you've gone and shot yourself in the foot. Okay? And now you've reloaded the gun and you're pointing it at the other foot. But recovery is there. Right, Little Britain. By the way, for Britain, I always call it Little Britain, but this time, instead of having a picture of Ting Tong Kadang Dang or something rude, I'm actually going to be nice to Britain today, because it has done very well, and that is a totally gratuitous shot of my 3.8 Mark II 1963, same year as me, actually 62, manual overdrive, wire wheels, you know, blah, blah, blah. I told you I was 50, right? So I'm doing my, you know, whatever you call it, midlife crisis thing. I haven't done the 18-year-old bimbo yet, but she is driving very well, British economy, right? as well as my Jaguar. And I have to say here that I expected Britain to have at least another year of being lower growth before getting to escape velocity before they come out, because of the amount of fiscal drag. Again, government not adding to demand to replace low private sector demand until they came out. Now, Britain has had 2 or 3 very bad years, so it's time they grew out of it. But this is a good result. And one of the things where I'd say you should look very, very carefully at investing, because everything in Britain these days is looking very positive. I've been re-looking at Britain. I've gone back into sterling. I'm looking at all sorts of real estate stuff there. We'll talk in the investment thing on PICS in the UK. Notice that they still have a current account deficit, but if you recognise the numbers, they're less bad than they used to be. But what I like, if you remember the EU version of industrial production, the business activity has returned. Manufacturing is moving again. In the EU, this is going nowhere. This is going nowhere. Confidence is low, and the investment side is very, very poor. This is just a quarter-on-quarter number, so that doesn't look so good. But if you look at year-on-year, it's much better than the EU. And customers are out spending. Not a lot. It's still a weak recovery. I'm not saying any of this is strong, but it is a recovery. And I'm looking next year at the UK, to my surprise, I think matching my strong call on the US and doing about 2.5% to maybe as much as 2.7, 2.75%, which is what I'm posting for the US next year. So the UK and the US could be level pegging and get close to that lovely, 3% growth that actually starts feeling like a bit of a boom. Okay? So that's where my money's going to be. Very, very good result. The US, my favoured pick and favoured economy and totally Keynesian, dovish, easy money supported economy, all of which I fully agree with, and you can see the results. Now remember, they are fighting fiscal drag that comes from the Republican Party stopping the government doing more than they could on the fiscal side. Never forget, the central bank doesn't want to use unorthodox policy and keep buying bonds at the rate of 85 billion a month and support the market and the asset markets and make all of you guys rich by holding, US equities. Their job is to provide easy money until the recovery takes off and then start tightening. They're doing it because the Republicans don't let the US government give the fiscal support and, by the way, build the much needed new roads and new railways and new infrastructure that America sorely needs. So they have no choice. Please, Hawks, don't forget that. It's not by design. But you can see the results are exceedingly good, right? Not only a growth level that could have been close to 2% if there wasn't shutdown, or at least about 1.8%, but their deficit is shrinking, okay, not growing at the same rate. The consumer price index, very important, is positive at the right kind of level. They've got a sufficient inflation in the system to make things healthy for business to invest again. Do not forget that deflation is a worse enemy than inflation for businesses, because you want a real interest rate that is either negative or, small enough to be worthwhile investing. If you have the threat of deflation, like you have in the Eurozone, you don't want to invest as a business. So you want a comfortable 2% inflation rate, which the UK is also achieving. Industrial production, remember the EU number, fantastic. Business confidence, up. Manufacturing confidence, flat, but I think that's more of a government shutdown thing. Business spending, that is only because of the government shutdown, but year on year is good. Retail sales, okay. Now, all of those numbers look okay, but not brilliant. And if you add them up, you say, hang on, only 3.2% in retail sales, only 3.2% in industrial production, only 2% in corporate. Where is this strong pickup in growth coming from? It doesn't seem to be coming from the usual thing of Americans out shopping, right? And when we look at the detailed numbers of Americans out, and there's a reason why I picked home base as the picture, okay, and a girl in home base rather than anything else, you will see that retail sales are weak, but they're recovering, but it's not particularly good. And even the cheap stuff, Walmart, Costco, Best Buy, these are all cheap places to buy, the lower end of the income scale. not particularly strong other than the cheapest of all, Costco, right? So people are going cheap. But the luxury stuff, the more expensive stuff, the Abercrombie and Fitch, the Pennies, the Nordstrom, the middle class stuff, limited. Women are still treating themselves as limited brands, because that's lingerie, but it's not high, okay? Where the action is Lowe's is a cheaper version of Homebase. It's basically housing-related stuff, which seems to signal that housing is on the move, and that's where the stuff is coming from, and that's exactly what is going on. I've always banged on about housing will lead the recovery, focus on housing. If you're an IFA and you want to post one economic number to focus on and look at with your clients every month, it should be the US housing market, and it's up there, finally. Remember I called the bottom a couple of years ago? That's when we started going back into US equities, purely on this number, combined with unemployment. And if you recall, I like to always look at the 50-year averages, not just because I'm 50, but it looks cool. And it tells you what the kind of housing start and build rate has been. And notice that having just about got the bottom right and then the pickup right, and that's when we start investing and you started investing, notice that starts are doing a lot better than purchases. And that is good for the economy, because housing starts means building, construction, timber, concrete, sand, land purchases, lawyers getting involved, blah, 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 all that kind of stuff. Much better for the economy. Right? Now, I'll talk a little bit later on what I mean. 80% of this is domestic input, which is an important thing I'm going to come back to, on one of the most important changes this year, and new things you're going to have to take into account. Okay? They don't import a lot. It's American timber, they have a lot of pine, they've got their own cement, they've got their own sand, etc., etc. So you need to take a note on that. The second thing that has driven this strong resurgence of demand again, or not so strong but okay, resurgence of demand in the US, is auto sales. Okay? And that is where the other big numbers are coming from to make up for those weak shop sales that you see. So the big double-digit numbers are in housing and autos. If you were smart enough, smarter than me, to buy not just the US market, which I told you to do, but US auto stock, you would have done exceedingly well, right? By the way, that's another gratuitous shot. I really am having my midlife crisis. You've got to have a convertible, right, if you're going to get the bimbo. So that's my Catalina. I'm still wondering whether to bring it into Sri Lanka or Singapore. I might bring it to Singapore. So if you want to do the 1963 American muscle car thing, it's a little bit later, 67, I would recommend those. Wide track, huge engines, 4.5 litre, V8s with Hemis and all that stuff, right? So buy American, and Americans are doing what I do, buy American. So it's not just a recovery in auto sales, but they are buying GM, right? They're even buying Chrysler, which make useless cars. They're buying Ford, which make reasonable cars, and they're not rushing out buying Hondas and Toyotas and so on. So it's interesting. They're back in the market. They're buying domestic. Of course, it is aided by fabulous credit at low interest rates supported by the Fed Dove, who enables that. And the best credit is coming from the American manufacturers. So a lot of credit is coming out. But why have customers run into autos rather than shops? It's because when you return to some pattern of normality in demand, right? Remember I said the first thing that drops off are the big ticket items of autos, which is why in a crisis, I saw this in Indonesia back in the financial crisis, the first thing that really falls off is the large ticket discretionary items that are luxuries, the car. Jewelry. US auto sales went down to as low as 10.5 million, what used to be a 17 million sales a year on year, for as long as I can remember. It dropped to as low as less than 11 million, which is extraordinary for the world's largest car market. Not anymore, now China is. It's now recovered to 16. So think about it. At the time of the crisis, remember the American crisis was a housing crisis that started in 06, 07, before the GFC. Suppose you've been the boom years, and so you always have a pretty new car, and you've had your car for, say, on average, 2 years, 3 years. Let's be generous, right? And you dropped off that major big-ticket item for the entire crisis. You had to give up stuff, right? It's now a 10-year-old car. The fleet has aged so much that one of the first things to swing all the way down, stay very low, and then really start swinging back up again is vehicles, because vehicles are the big ticket item. You sit there with a car getting older and older, and then when you start having a bit of money again, the first thing you replace is the car, because by then it's 10 years, and it's depreciated a lot, and the maintenance costs have gone up, and all that kind of stuff, and you want a more fuel-efficient model, and cars have moved on in 10 years. That is why auto sales are leading the recovery. Okay, so that is the US economy, right? That's the essence of what's driving this growth. And it's going to continue next year and the year after. So as I said, I'm pegging about 2.5 to 2.7 for next year. It could get to the fabulous velocity of about 3% in 2015. Okay, so it's looking good. We'll talk about investment at the end because the problem is the market is fairly highly strung out at the moment. There's a couple of other things that are new. So new that nobody had really predicted them. I hadn't predicted them. It's changing the way the US market is going to work and the global economy is going to work. You need to take account of it. If you're an IFA, you need to think about this because this hasn't happened before. And just to illustrate that, we just have to admit she looks quite attractive. The funny thing about that was, and this is the midlife, I could put her in the Pontiac. Right? I didn't know about that extraordinary change. I couldn't believe it. So, you know, a normal father in a normal family, you would not let your 12-year-old daughter look at stuff like that. And the trouble with being a single father is you don't have any control on these things. So it was actually my 12-year-old daughter who showed me that. And when she showed it to me, when it got to the bit where she's naked, she put her hand over my eyes and said, "Papa, you can't look at this bit." But she carried on watching. So such is change. So there is a couple of things that are dramatically changing in the US economy that have surprised a lot of economists. Now, I have gone on for a long time that people will deleverage, they will spend less, they will save more. That, I know, I got that right, because I saw that in the Asian financial crisis and all the economies I was dealing with at the time. In Indonesia, Malaysia, and Thailand, that is a pattern that happens. And sure enough, American consumers are now, deleveraged down to less than 100% of their household income, from 130 to 90. They have saved up to 5% of their income, which for an American is a miracle, given it used to be almost zero. Right? They're not Chinese, remember. But the extraordinary thing is, now they are returning to shops and shopping and buying cars and buying things for their house. They are not doing it with imports as much as they used to. Everything before used to be Chinese, right? You walk into Walmart, and it was extraordinary. You tip over everything was made in China. The barbecue sets, dog kennels, everything, the garden hoses. The trade deficit that everybody thought would never, ever move is moving in the right way. So again, for all the naysayers and the hawks and the, how will you pay all this debt? Well, America, I reckon, could get to the point where it's going to balance its trade. And if you look at the figures for those vehicles, 80% of them, domestic imports, right? Well, things come. And the housing, 80% of it, domestic imports, okay? They are buying American. There is one other extraordinary change that nobody had anticipated. And those of you will remember, I was always a peak oil theory guy, and I was always nervous about the American peaking as the world's largest oil producer in the 1970s, and the continuous slide since, and the huge demand for energy from new emerging markets, and the Chinese and the Indians and all of us fighting for oil, and the energy intensity of the world, and where is that going to lead? The geopolitical stresses you saw, which many argue led to all of the Middle East turmoil and the Iraq invasion and all that kind of stuff, right? Who would have figured out, and I'm no technical oil expert, so I'm sure there'll be some in the audience who can tell me more about this, that this tight oil thing, shale oil, and even more importantly, shale gas, would end up having such a dramatic effect on US oil production. As you can see, the peak oil theorists are right. Look, US production did peak in the mid-70s, and it has been on continuous decline since, including Alaska, and was meant to just carry on going down like this, and we would always have oil price shocks which help drive inflation. Right? This shale oil thing is dramatically changing the nature of the US economy and the nature of half of the import bill and the trade deficit is, by the way, oil. The rest are non-consumer durables, ex-autos, and capital machinery. And as we said, business investment has been poor, and that's the reason why those things haven't picked up. So this is having a dramatic impact on the US economy. So it's autos, it's housing, and it's shale oil and gas-driven recovery. Okay? And that, I think, is going to have a big impact because oil helps drive inflation. And this puts a cap on inflation in the US economy. And all the hawks keep arguing the biggest issue is a return to growth, leads a return to inflation where you have a huge amount of debt and the currency will then get into trouble. That's the nightmare scenario. But this helps put a cap on that risk. And this is only going to get more. Now, I'm not here going to talk about the environmental issues and the risks and poison water and political blah, blah, blah. I don't know enough about it. All I'm saying is this is economically important and you need to factor that into your investment decisions. For me, it just makes the US even more attractive and the dollar even more stable. Okay? For those of you who want to work out what this means for the rest of the world, I have no idea, but that is a map of where else there is this stuff called tight oil, and I think even more importantly, tight gas. So it's going to have a knock-on effect in a lot of economies around the world. Russia has a lot, right? Canada has quite a bit. Europe has some stuff. But notice that one place that doesn't have a lot is, the traditional producers of Saudi Arabia, Iran, all that kind of stuff, but Libya has a lot. So exciting stuff. Watch this space, but it is going to have an economic impact that can only be positive. Okay, so that's G2 plus Britain. China. Now, again, I have never been a naysayer on China, but there are a lot of people out there who always talk about the coming impending implosion, doom, housing collapse, infrastructure collapse, blah, blah, blah of China. Okay? I'm afraid to date, year on year on year, the Chinese prove them wrong and come out with an exceedingly strong performance. So yes, they tipped over. Yes, there was a slowdown. Many economists, including me, argued that it would be a soft landing, not a hard landing. It has been a soft landing, and if you look at those numbers, it all looks fantastic. Auto sales hugely up. It's now the largest car market. It's still industrial production driven. Yes, I know a lot of that's still going into state-owned enterprises, and it's not all necessarily efficient, but it's keep the engine humming. Confidence is there, earnings are up, and you are seeing strong growth in retail sales. I am not saying that China has rebalanced as much as it should. I've always been a critic of the low level of consumption of the Chinese relative to where they should be. I still say they save too much and spend too little, and they are aware that they have to rebalance the economy. But look at the export figure. The export figure is down. For the first time, China is now flatlining. It's not continuing to grow. It's surplus over other countries. It is now starting to be rich enough to import more and export less relatively. So China has done a fantastic job. India, on the other hand, has done an appalling job. Okay? I'm very disappointed in this because, these guys sitting at the top, Chidambaram, Singh, they are just as smart as the very, very smart people running the Chinese economy. And of course, we all know they're a lot more democratic. But as economists have always, unfortunately, found out, democracy is no match for poor economic management, which is why the Chinese continue to win and the Indians continue to lose. They had a huge opportunity. There was a flood of cheap, easy money, fabulous monetary conditions, QE keeping support going. All the emerging markets out there have the opportunity to add at least 1.5 to 2 percentage points of growth, as they did for a couple of years, going up to, I think, as much as 9%, right? While they sorted out all of the huge structural deficits that hold their economy back from being like China, i.e. you do need roads, you do need rail, you do need infrastructure, you do need logistics, you do need distribution. Evidently, about 40% of all Indian food and consumables rots before it gets to market because the distribution system is so appalling. right? Which helps drive up inflation and gives them this inflation issue all the time. So look at their auto sales compared to China, look at their industrial production, look at their export performance, look at their business confidence, right? Look at the inflation they still have, the CPI, which is all from inefficiency, the limited growth they have still, a 5% growth rate is still now leading to 8-9% inflation in India because of the structural deficiencies. And look at their GDP per cap and where they are. I mean, to be doing 4.4%, I mean, that in India, when half the population is still technically poor, that is an appalling result. So, that was your quick spin through macro. The long run, of course, I'm still saying emerging market. I'm still betting on emerging markets, growth of the middle class, consumption, urbanization, education, food and beverage via trendy things that middle class like to do. In my case, coffee bean and tea leaves and pizzas and donuts and things like that. Some real estate. All of that stuff is still on the table, but it does mean that these markets are riskier, less attractive, and equities will certainly be a lot worse for places like India. So the third and final bit of the economics part is money, right? And money, the whole thing here is the great tapering debate, which everyone likes to have, and I'll give you my take on that, and the whole hawk versus dove thing, and you've seen already why I maintain my dovishness, why I'm still, a dyed-in-the-wool Keynesian in situations of deep stress and private sector demand collapse. I'm not always like this, but in times like this, when it's a banking crisis, and I think I know a few things about banking crises, this is the reason why I maintain my dove position. Now, for investors and for the Fry Group and for IFAs and even for companies with looking at their economic planning, I still firmly believe, in my view, that the doves, firstly, the doves are in control, you can't debate that. They will stay in control, and we will continue to have an era of very easy money for at least another couple of years. And as you know, I am strange, and I'm an economist that then invests, and I always I invest in my own economics, so if I'm wrong, I screw up. We've just done a latest round of refinancing because we've always used easy money, taken advantage of the fact that debt is cheap, right? Which is what I hope all of you have been doing for the last 4 or 5 years. So we just completed our last 25 mil refinancing and we build our own yield curves for Singapore and all that stuff because there isn't really very good yield curves. We've opted for variable, not fixed, okay? And we do a 2-year refinancing cycle, right? So I'm putting my money on at least another 2 years of easy money, irrespective of what happens to quantitative easing and tapering. Okay? I do not believe demand growth is yet strong enough. I do not believe that Europe is at escape velocity, even though the equity markets may do well. I do not believe that even the US, that I say will do about 2.5 next year, I do not believe it's there yet for the reason I'll go into that the central bankers all agree, which is they're looking not just at growth and not just at inflation, but at underutilized capacity, a thing economists refer to as slack and unemployment. Okay, so you've got to, if you're an IFA, you've got to look at slack, not just growth and inflation. And you have to ask yourself, why are the doves still politically in charge? Why are they letting them do this? Why are rates still so low, but effectively they're still giving money away? Why has the ECB taken rates down? Okay, why is therefore inflation still so benign? And the hawks who said inflation would go up, it hasn't gone up. What is going on? Right? And why will I believe they still be in charge? Okay? Such radical monetary policy has not led to inflation. Every year, every one of you who's a hawk has told me this will all end badly. You've been proved wrong for 5 years for one simple reason. Growth and the resumption of demand has not yet got to the point where it has replaced the lost growth and the lost path that we would have been if we hadn't had the great financial crisis and carried on a lower but still growing trajectory. World growth is not back where it was. Even Britain, which I'm saying is doing really well, invest in Britain, it's all fabulous, it hasn't got back to where it was back in 2007. The US has just reached it. And the reason is there is still a lot of slack in the economy. And that slack comes through in unutilized capacity in factories and fixed investment, which is a much more difficult thing to measure for economists. An easy thing to measure, which is unemployment. And that's the reason why central bankers, the Dove central bankers, are focusing on a remit that is not just inflation, but unemployment. Right? So if you're an IFA and you want to know where tapering is going to come, and you want to know the direction of monetary policy and when this easy money party ends, which by the way is exceedingly good for risk assets and the equities you put your customers in, I hope, focus on looking at unemployment. You don't need to see me for another year, just stick this, I have this as my screensaver. Okay? It's very, very simple. And the magic number appears to be 7, and for the US it appears to be 6.5. I actually think a NAIRU is closer to 5. NAIRU is a technical economist term. Non-accelerating inflation residual unemployment, which is basically the level of unemployment you will always have in a developed market economy when you're growing at full capacity, when everyone's employed. It's the people who just won't work or can't work or are too lazy to work or can't get out of bed, right? So let's call that 5%, okay? 5.5% to 6% if you're generous. So when that number starts tipping below the 7% point, that is the point that easy money is going to come off, and it's the point at which you need to start looking at the build-up of inflation. Hopefully there'll be enough growth by then from these people coming back into the market to spend that you will have real genuine inflation, real genuine growth. You won't worry about it anymore. But risk assets, of course, will get nervous and take a dip for a while. And we're not there yet, okay? It's not bad, and it's dead on the 7-year line that I put up 2 years ago, 3 years ago, whenever it was, 3 years ago, right? 4 years ago. But the fact is, it's on the 7-year line. It's not on the optimistic case 5-year line. And previous, less nasty recessions were also slow and largely jobless and took 7 years and 8 years, respectively, the 90s and the dot-com bubble, to recover employment, okay? And the job of the government and the central banks are to get demand back through employment, not just keep a lid on inflation. And this keeps a lid on inflation. And that is why inflation remains very, very low. Look at the EU unemployment and you can see why it's got such a long way to go. And remember, all these numbers up here are the official government numbers, therefore they're completely fake. And you have to add at least 4% minimum to all of these numbers to get the real unemployment level. It doesn't count people if you just left college, if you've got children and they've left college, they're not counted because they never work, so they're not registered. And if you've opted not to be registered as unemployed and you just don't want to work anymore, you're not counted, okay? And if you're working part-time, you're not counted, okay? So, and if you've been out of work for a year, you drop off because you're considered just unemployable or whatever. So, government economists massage this stuff, so actually the real numbers are a lot higher. We've got a way to go. That's what's keeping a lid on inflation. Okay? So don't worry about the inflation hawks who say the party will be over tomorrow. It will be over, but you've still got at least 18 months to 2 years. Okay? The bond markets agree with the Doves. The bond markets agree with myself. Okay? The hawks are not yet agreeing with this because I put up the lines every time we meet each other. So the last time, October 12th, yellow line was when I last saw you, okay, a year ago. Notice the yield curves every year that the austerity naysayers, right, going back to 2009, kept saying, oh, inflation's going to build up and it will all end badly and blah, blah, blah. It actually went the other way. Rates went down, okay? And the yield curves shifted this way, right, to the right, not to the left. For the first time, and this is a good sign, in the US and the UK, notice the red line, which is the yield curve as we sit right now, has for the first time shifted to the left, which is good. So the market, the bond market, is for the first time expecting the resumption of some inflation and to peak out by about 100 basis points. But notice the line is not moving for the first 2 years. Look at that red line versus the yellow line. Even for the US and the UK, where there's now growth, the bond market is saying we expect rates to start going up. But for the 2-year curve, they're still holding it flat and exactly the same as it was as the yellow line. And it's when you get out 5-year, 10-year that they're putting out by about 100 basis points. So the market seems to agree we will continue to have easy money policy, which is very good for risk assets, very good for IFAs, for at least another couple of years. These guys will continue to support you in the equity markets. They want risk assets to do well. Okay, so that is monetary policy. There are still risks, okay? Though the doves control things, there is still the Republican Tea Party. There's still this feeble speaker who allows himself to be shanghaied by the guys that you saw, which is John Blow. So everyone makes a joke about, how do you pronounce this guy's name? And is it Boner, right? That was another question I got from the sons. What's a boner? Why are you laughing? By the way, I haven't said anything about what it is, so somebody maybe can tackle that question for me, but I thought that was quite a good one. So as a result, I have given this guy what I call the No Kahuna Award. This is a question from Ms. Harlett that we did answer by doing a Google search on what a kahuna means. And I thought that was so good I just put that out, right? Because, most of this I didn't know. I love it. Cracker Jacks, family jewels. I like the hanging brain. One woman said to me, yeah, that figures for a man. Cabangas, knackers. Anyway, man Thompson, I've never heard of a pelota before. Fun rocks, stones, tenders, and 2 veg. I like the 2 veg. So this guy really doesn't have any balls at all. And unfortunately, he's still there. I actually think that come midterm congressional elections, he is going to suffer from taking the sensible, just orderly conservative Republican majority and allowing them to continually be shanghaied by the Tea Party thing. But since he is the Republican, House Speaker, and since he is the voice of the Republican Party in all debates with the Obama government, where he allows himself to be pushed is where the entire Congress and caucus is going to go, which means that every time they have a debate, the next one, by the way, is February on the budget, everything is going to stop because the Tea Party they just hate Obama. They'll do anything to stop it, and if it means, shoving the whole US economy into gridlock, they will do that. So we will continue to have sideline political noise. But again, for those of you who are advisors, I will regard this as sideline. Do not exit the market. Stay in, shut your eyes, expect transactions and liquidity to go out. Don't try to be stupid and sell anything on behalf of your clients. And come back when it's all over, and you will be okay. And okay, the S&P will go down by 5% adjustment, and it will quickly bounce back again by 5%. Then they'll add a couple of percent for good measure for a relief rally and hold it. Okay? So it's not going to affect the 2.5 to 2.75, 2.8 growth I think the US will have. It's just going to be like going to the West End and watching a good play. Okay? Actually, it would be like going to the West End watching a bad play. But depending on whether you like this kind of thing. Okay, I thought that was good. So evidently it's pronounced Boehner, not Boner. But I mean, I rest my case, right? He really is. Okay, so that's monetary policy. So, as I said last week, don't fight the Fed, don't fight the doves. The doves are now in charge. Draghi's there, Trichet has gone. You will still have a great environment for risk assets supported by easy money. Do go long on debt, refinance out, stick to a 2-year cycle, borrow as much as you can, right, while you still have this chance. Okay, finally, emerging markets. So this is the last bit on macro. And this bit is, of course, very quick because it's just the sort of frontier markets that we all like investing in, and guys like me like investing in. What on earth went wrong? Well, it's basically a smaller version of what happened with India. Okay? If you have very benign monetary environment with lots of free money being handed out, of course, a lot of that QE and a lot of the easy money flowed into risk assets all over the world, right? Including, frontier markets and emerging markets, and all those markets that went up so strongly, and not as stock markets, but the economies. The problem is people running them, from Rajapaksa in Sri Lanka to Yudhoyono in Indonesia, they all had this idea, wow, we are geniuses, this is all us. Well, it wasn't just you, it was lots of cheap, free, easy money. And you were meant to take the benign environment for 2 or 3 years and put in structural reforms. And those who did have done well, and those who are well managed financially, both fiscally and on money side, have done okay, and their markets will not suffer and didn't suffer in a horrible summer meltdown that many of you would have felt. Okay? And those that carried on not reforming the system and still having fiscal deficits. So the bottom line here is the fiscal deficit, and the top line is the current account balance. So my beloved Sri Lanka is running a current account balance of minus 4.7% of GDP, okay? Mainly because they're importing lots of foreign cars. And the fiscal deficit is minus 6.4, which is terrible. Okay? Remember, when you have a fiscal deficit, who is going to pay for that? Foreigners have to, because your savings rate is too low. Sri Lankans are saving at the rate of 17%. They have demand for 25%. So, there's a deficit. Okay? And if you look at India, appalling performance, still very weak. That's Turkey. Now you can see why the Turkish lira went down. Okay, that's Indonesia, better than the others. So if you're going to bet on somebody that will still recover and when markets go down, go back in, I would pick Indonesia over Turkey, over Sri Lanka, over India, right? Russia, of course, is just a commodities play. That's the reason why it has a positive current account balance selling oil. But look at the once great Brazil, okay? So, you have to be careful. If you want to know who's going to go down when the tapering starts and the emerging market risks start coming up, the guys who are weak and who will suffer in their currencies are these guys. Okay? Notice I have something you've never seen up there before. That is Bangladesh, 140 billion economy. The numbers at the bottom are the size of the economy. Okay? It has a current account positive balance. India and Sri Lanka doesn't. Right? It's better managed than India and Sri Lanka. Okay? It's textiles. You're most probably wearing something made by Bangladeshis, hopefully not in a building that's fallen down on them. And it has a huge amount of other stuff, rubber and coir and all sorts of things. All the ships in the world are broken up there. Okay? So it's one of the interesting frontier markets that I'll talk about in my sort of top picks for contrarian, high-risk, direct investment bets at the end. Okay, so the fall will come in the currencies. So if you or your customers or your investment advisors have you exposed to the great BRIC thing, by the way, BRIC, why do I call it BRICs instead of BRIC? BRIC is the usual Brazil, Russia, India, China, and I add Indonesia, Turkey, and to be totally unobjective, Sri Lanka, so it becomes BRICs. Okay? If you have exposure here, and if you are in with the rupee, the real, the Turkish lira, we couldn't get the data for the Indonesian rupiah, but it's followed the same path. You're already nursing about a 15 to 20% loss, okay? And even though the markets, equity markets have bounced back, currencies haven't. What's that telling you? That the market has now recognized that these guys are running risk, and when the era of easy money goes over, when the tapering starts and the QE is turned off, okay, the guys with fiscal deficits, current account deficits are going to suffer, and these are the guys that will suffer. The best one of all, and the one to get back in when there's a sell down and a chance to buy in cheap, I believe, is Indonesia. So another meme, I love this one. Right? This is Rodham, this baseball star, hanging out with Kim Il in North Korea. So that is basically a quick tour of global macroeconomics and emerging markets. Okay? We'll take questions on the other markets. As I said, I haven't put up Japan to try and keep it at around the hour level, and East Europe. So we end with, because as I said, I'm primarily here, I'm an economist, I'm not meant to be an investment advisor, that's what you've got the Fry Group for, or your advisors sitting around you. I'm meant to tell you where economics are going and give you some pointers, but I have in the last 3 years, and because these IFAs are kind enough to sponsor this, put up at least some views on investment. I think I'm most probably better on the economics than investment, but I do say what we told you should do, how we do. I do give you some pointers on what I do, some of which works. And, you know, we just do a quick tour of the markets. Now, the last couple of years, I've been right. I was overly cautious, as all economists, on the EU. I still am very cautious on the EU. The markets behave differently to the way economics do. And the markets anticipate, they buy, you know, the story, not the news, and they go on forward optimism. So though I still don't like EU's recovery and austerity policies and the whole position, European markets have done exceedingly well. But I'm happy with what I told you, which is if you want the low-risk, pure economic bet, buy the US, right? So there's no excuses for any of you not making at least 20%, but in euro terms you would have made, you know, 18-20% in the European markets. I did say very clearly there is no rational reason to be long debt at this stage of the cycle, because even though I'm saying easy money will stay for a while and rates will be flat for a bit before it takes off, when it does take off, you can't predict the timing, and you do not want to be long debt when rates start moving up. And as you've seen, inflation is now picking up, and the yield curve is picking up, and that's why people have been losing money in debt markets. What on earth has happened to the emerging markets that are doing so well? Well, as I told you, once you start seeing money off, QE off, those markets that are fiscally and current account deficit poor have been hit, and that's why all the emerging markets, the Indonesias, the Indias, the Sri Lankas are being hit. But that doesn't explain what's happened to the well-managed, advanced, exporting Asian economies, the Asian tigers of Singapore, Korea, and Taiwan. What's going on there? We'll come to that in a minute, but basically it's all to do with the way trading patterns have changed. This was last year, so if you remember that's what we showed you last year, where it was a fabulous year for equities, including emerging markets. Again, my call was for long US, short all debt, and we still had some exposure and we're still positive about some of the better emerging markets, so that was a great year. And if you remember, this was the year before, right? Hopefully you were, because we had told you to be short equities for that year, I hope your IFAs didn't keep you in, or at least you just held for the year. I think that was the year that we had said to do the commodities play in housing. In terms of Singapore housing and real estate, our real estate plays, one of the, I think it's Ken Mandel reminded me about warning you guys to exit or at least reduce your holdings, stop buying Singapore Resi. As you know, we started our exit of Resi, Singapore Resi 2 years ago. It's, by the way, taken me 2 years to exit, and I've still got 15% left if anybody wants to buy a couple of apartments. They're still sitting there, nice, you know, middle class Singapore residential stuff. But at Calamanda Group, we took the decision that the market would continue to grow at a much lower, softer pace for one key reason. The MAS and Singapore government made a firm decision that the extreme cyclicality, boom-bust cycle of a market that is still very small, huge amounts of liquidity, one of the highest saving rates in the world, but 80% of the population still live in government-provided HDB housing, continued to have this boom-bust cycle. And every time you had, you know, risk back on a bit, but not much else to invest in, and very, very low interest rates, and getting nothing on deposits when Singaporeans are all such big savers, you have this rush in property, which is why we were, if you recall, positive on Singapore property after the crisis into 09, 010. And they have made a policy decision that this is a market they're now going to intervene. Okay, so the underlying fundamental demand positiveness on Singapore real estate hasn't gone away. There's still 80% population wanting to be in a private condo. But in a market like this, if the state decides to control it and control growth, and they control the land bank, they control the stock of Singapore dollars, they control the largest bank, they control credit policy through the MAS and how much banks can lend, and they control what? Number 1 and number 4 of the largest developers in the country, right, for private housing stock, they control the market. Okay, so don't fight it, right? Which is why, I think it will settle into, the demand will always be there, but it will tick along at what they want it to be, which is around GDP growth plus a few percent, so it'll be 4, 5, 6% a year. That's no longer interesting for Calamander, so that's why we told you 2 years ago that we would rather go into other stuff. So that's Singapore Resi. Since somebody, I got a couple of questions by email, so that's the reason why I wanted to answer that. And this is our take on markets. Now again, look, your investment advisors and the Fry Group are here to talk to you about this. I'm not an IFA, I don't want you to. I'm giving you an economist's take on the way I think, as I do to you now for the last couple of years, and the way my company will act, and what we do with our investors. But our investors are much more specialised, and we tend to do direct investment with our investors. But the good news for IFAs, the good news for a Fry Group is, it's now back to economics. That's been my underlying message. And you'll continue to go and have easy money, and that's great for risk assets. The bad news is that everyone floods into the markets a little bit too early, right? And it's going to be a lot tougher for you to advise your clients this year and make money for them. Not because the economics aren't going to be good, the economics are going to be great. And 2015 will be even better. But I don't like the level of markets right now. Okay? I am on hold, take profit for the US. And actually, that is being conservative. I take profit for the US market. Way too profit. So I regard equities, most equities, at full value. In the US case, I think it's overvalued. The only positive, that doesn't mean the market's not going to carry on going up. Remember, I'm actually very risk averse, even though I like all these dodgy frontier markets. The market will continue to go up because there's A, nothing else to invest in, okay, until you get another little Republican thing where it will tip down again. And B, amateur investors who are always late to the party are finally woken up, and now they're all jumping into the market where the professionals were in a couple of years ago, which for me is always a signal of time to get out, okay? Because at some point, it's going to push it up too much and then take it down. And if you want to see what I'm saying, just look at NASDAQ and just look at what they sold these social media things that I don't understand at the prices they're trading at. I still don't know what they do. I still don't understand how they make money. I look at the figures that they quote for profit, and I think it's all bullshit, and it's all measures of, I don't know. It used to be eyeballs, and that's something else. But, and I still believe you shouldn't invest in what you don't understand, but the numbers are ridiculous. And S&P at 17.9, beyond long-term, 10-year averages, that makes me nervous, right? The DAX at 14.6 in fiscal drag austerity in Europe. The UK I like, but I don't like the broad market, but I put them down in my stock pick bit, okay? Indonesia 16.7 when we're going to hit